Well, HE double hockey sticks, I'm a little bit concerned because my concerns that the market was going to sell off after Fed Jerome Powell's speech were wrong immediately after Jerome spoke, but they are proving correct today. After all we got yesterday was coddling, and the market was really comfortable with the coddling it got from Jerome Powell, who talked to us like we were 5. Today, though, reality set in. And the Fed did nothing for us yesterday. They didn't say they were going to buy more bonds. They didn't say they were going to do yield curve controls. They didn't say banks could leave more of their money in the markets rather than in reserves by extending the liquidity reserve requirements. We have none of that. We literally got nothing today. That coddling cuddliness we got from yesterday is gone. So what instead do we have? Well, we get to look at bond yields, which those are not very pretty. And nobody's really talking about this, but it's so important. So I'm going to briefly review this 5-year chart, which tends to have a larger correlation with the stock market over the 10-year. The stock market seems to be a little bit more sensitive to the 5-year. But anyway, obviously, this is the 1-year chart of the 5-year bond here. We see, obviously, rates coming down, trending down from August roughly to the end of December. We get this slope of an increase here, this red line that we've got here. We see a nice solid, sustained increase of bond yields. Where things are really becoming a problem is here recently, since January. This is the slope we have had of bond yields increasing. That is a much, much more rapid pace than obviously the red line increase here. And it just gets worse here around February 19th, which is approximately when we hit the peak of the tech market, and then we started having the tech wreck for about 2 weeks, and then lately we've just been volatile up and down. It's been pretty much a disaster. You can see the slope of this line is even more steep. This becomes a concern because we might very well run to new highs very quickly in bonds. And over this next 3-month period here, my warning holds firm, and this is a warning I came up with about a week and a half ago when the market was nice and green and recovering and everything was beautiful. We're like, yay, we bought the dip, everything's all good. I'm like, we gotta be careful. Don't get lulled into overconfidence, okay? Just because we bought the dip and maybe we're up on some of our dip buys or we're not as down as we were before, doesn't mean we can walk around in this market overconfident, thinking that, oh, there's no way it's gonna fall again. It can. And in my opinion, if this acceleration in these bond yields continues, which I think it will, we're going to see some serious pain over the next 3 months, especially as CPI data comes in higher than expected. We know it's going to come in higher than expected year over year. Month to month could come in temporarily high as well. The problem is, I really think the market's going to hear Jerome Powell say, inflation's going to go up temporarily. And all they will have heard was inflation's going to go up. Oh, up. He said it. Sell everything. It's the Weenie Babies of this world that are like, if we even have inflation temporarily, I'm going to move all of my funds assets, or we're going to take a lot of our funds assets and we're going to go out of high value tech. The companies that are changing the freaking world. The companies that have high multiples because they are companies that are transforming the world. The reason Tesla has a future, in my opinion, forward PE of 70 is because by 2030, Tesla's not going to be done growing. Tesla's just going to be at the beginning of this massive climate change driven revolution towards EV and energy and solar that we're seeing. Electrifying semi-trucks. Oh my gosh, it's going to be 30, 40 years before we actually electrify our car fleets out here. Here we are worried about what's going to happen in the next 6 months. We got 40 years of EV growth ahead of us. People are like, oh, Tesla's going to stop growing in 2030. Really? Like, the point here is you've got to ask yourself, do you want to be with the Weenie Babies right now who are investing in companies that are, sure, maybe beat down because of the pandemic, maybe get a short-term bump back? There's no problem with that. That's not necessarily a bad thing. It's a great sort of momentum trade. Hey, encourage looking into that. Look for those beat down companies. I mean, heck, you want beat down companies? Look at Lordstown. Now, I'm not endorsing Lordstown yet, but I'll tell you, in terms of beat down, that's beat down. I'll do some research on Lordstown. We'll see. Do we want to jump into the negative news? Like, I'd rather jump into the fire pit with some of my favorite stocks when they're down and double down on my positions in the fire pit than go chasing stocks that are getting hyped up or that are getting rotated into by the Weenie Babies. So the thing about the Weenie Babies is they're very, very emotional. As soon as we realize, and I think we got to get through these next 3 months, I think, once we get to like May, June, July, and we start realizing, okay, maybe Jerome was right. Maybe inflation is subsiding in the event that happens. We're going to see these Weenie Babies rotate right back. And to me, as painful as it seems to be sitting here going, oh man, like we were just up 3% and now we're down 5 again. And then it's like, oh, we're up 3 the next day. And then, oh, we're down 6 now. Like it really feels like 1 step forward and 2 step back this market. And it's really tempting to just say, that's it. Sell out. I can't take the pain anymore. It's the same thing, right? It's the same thing as what we were talking about during the crash. Your fight or flight instincts turn on. It's like, I can't take the day after day, 1 step forward, 2 steps back. I can't take it anymore. It motivates you to get out of these companies that are going to change the world over the next 30 years. And personally, this is the best time to be adding to those types of positions. Now, advice part, and not financial advice. Of course, this is just for entertainment purposes only because I'm just a dude on YouTube who suggests that you should totally check out my programs on building your wealth, link down below, using the 38% off coupon code because, well, we extended it for a couple of days as people are getting their stimulus checks, and supposedly everybody's supposed to have their stimulus checks by tomorrow. But anyway, what's kind of my thinking here? So my thinking is, look, as much as possible, I am identifying opportunities that as soon as they fall below certain price points, I'm going to be buying them heavy. Obviously, I announce all of the buys that I make in the Stocks and Psychology Money Group. But the point here is, I think possibly you might be considering or should consider doing the same thing as well. Ask yourself, forget what prices went up or down today or yesterday or last week. Look at the actual prices themselves and compare that to what you think the company's worth. And then look, hey, if we can get another 10% discount over the next few weeks, what if we get another 30% discount over the next few weeks? First question that should be going through your mind is, am I going to get margin called? Because if you're going into this madness these next 3 months over 20% margin, I think you're doing it wrong. I think you're really doing it wrong. Right now, as of my last calcs, I'm right about 28.2% margin. So I'm getting down under 20. And that's without selling any stocks. Although I'm considering doing a couple sells, and then I'll really be right at 20%. So we'll see what happens there. But the point is, right now, if you're good on margin, identify those stocks and maybe consider even setting some limit orders where you look and say, hey, all right, we know Tesla's 666. Can I get 625 again? Can I get 39 again on NEO? Can I get 23 again on Lucid? Can I get 140 again on Enphase? Are we going to go sub 200 on DocuSign, or is Etsy going to go under 190? Look, don't get me wrong. The high-flying stocks of the day are always the sexy ones to look at too, right? And this is what happens. You get a stock like Upstart, that's up 40-50% on the day. Then it goes trending on Robinhood. Everybody buys in at peaks and the thing goes up 100%. Look, that is freaking amazing. And so far, I'm bullish on what I'm seeing at Upstart. But I have to say, personally, don't love the idea of chasing the high-flying trending stocks. I'm trying to look where other people aren't looking, like some of the names that I mentioned here. And one of the reasons for that is the next 3 months are going to be painful. And I strongly believe that, and I'm planning for that pain. But the 9 months after these next 3 months, like once these 3 months go by, and then we get to the next year from, say, June, July, all the way to June, July of 2022, do I really think the tech stocks I'm buying today are going to be cheaper than where they are today? Personally, I don't think so. Maybe that has to do with my inflation beliefs. Maybe you've got to ask yourself, do I actually think we're fighting deflation? And the reason we're not seeing so much inflation is because we're money printing our way out of deflation because of global competitiveness, globalism, capitalism leading to price cuts and price competitiveness, and technology leading prices to decline. Do you believe that? Or do you believe, look, man, Biden's going to come in, raise taxes, we're going to get the infrastructure, man, all this spending. Oh my gosh, 3 plus 1.9, that's $4.9 trillion. That's like 25% of our GDP, a little less, 23% of our GDP. That's nuts. Like, how could there not be inflation? If you believe that, that's fine. Then hedge yourself. I mean, what's doing well in the inflationary time right now? We call it the reflation trade, right? Reflation stocks are classic banks, commodities, and the ones that are deemed to be a value, right? Which right now is retail, hospitality, travel, the airlines, and so on. This is all part of the big, what I call the Weenie Baby rotation. And that's not to say you can't make money on those stocks. I'm not mad at you if you're making money on the airlines or Carnival. No. I want you to know, I'm happy for you. All I want to say is these things come and go in cycles. So if you're tech heavy and you feel like you're bleeding, it's normal. If you're recovery and reflation heavy and you're winning right now, good. Great. That's awesome. But look for those opportunities where things are selling off. Now, how bad do I think this can get? This market volatility and crash crap over the next 3 months. I think we can revisit pretty close to some of the lows that we've seen over the past few weeks, but I don't think we're going to get exactly to those lows or exceed those. Now, I could be wrong, but here's my thought. When we first got hit with this, boom, bond yields going up and everybody's like, we'll sell everything. I think we had a substantial overreaction. So some of those really low prices we saw, like if we pull up Tesla, for example, just as a simple, easy one to pull up, we know there was a time this thing went down to somewhere around $530 a share. Pretty dang low. Let's see here. So going into the days interval, we had 539 was the low when we pull up Weeble here. 539 was the recent low. I would not be surprised to see us sort of leave the bounds that we've been trading in the last few days, retest these lows, and in fact, I'll draw a line down. We'll see how it goes. Wouldn't be surprised if we get within about 10% of that, which would be somewhere around 580, something like that. Wouldn't be surprised if we end up testing, have some volatility. Maybe we'll trade within the lines here. It's possible we could dip down again to some of these levels. I think if Tesla, to me, goes under 6, it's time for me to start really buying some more, maybe even like 610 somewhere here. So like this is going to be my buy range right here. All of this is going to be my hold range. And certainly if it goes up, it's just tendies. But I'll have cash on the side so that if we do revisit some of these lows over here, and we're within 10% of the bottoms, 10 to 20% of the bottoms that we saw on March 8th, March 9th, around that period of time, March 7th, right around there, then that's going to be time for me to buy, because I don't know that, and certainly what do I know, but again, I believe because we had that peak shock factor, that slap in the face, that markets are more like, okay, all right, we get it. Bonds are going up. Yeah, we might have another jump of bond yields going up again. Maybe the 10-year will go over 2%, right? And we'll see more of these sort of V's and this sort of jigger-jagger as we readjust here. Over time, I think this is all just going to be a little blip on the radar, but it just would not shock me at all. And so that's going to be my current target for a lot of stocks. Even if we go on over to like a Neo or Palantir being, relatively close to some of these numbers. Palantir, though, did go down to 20 on its lowest day, down into the 22s for a period of time here. So same thing here. If I went 10%, 20%, somewhere around here, probably would have to be around 22 for something like Palantir. To really say, okay, here's a 22 line. We're close here. So somewhere between this area here, maybe under 23 for Palantir, somewhere kind of in this box right here. So if we break through the bottom here, maybe it's time to go shopping again. And again, these are just my projections, my opinions. I'd rather, at these levels, I'd rather hold cash is the argument. So I'd rather hold cash right now just in case, that dip comes. If it doesn't come, that's all right. We've got enough tendies in the oven, so to speak, and those will print really nicely. If we fall, I go shopping again. But I'm going to wait to be within 10 to 20% of those rock bottoms. So just to do another example here, let's pick just one more here. Why don't we pick... I don't know. We'll pick Zillow, okay? Just out of nowhere here. Let's pick Zillow. So Zillow, just here in this last crash here, went down to about 122-ish. We're at 133, so we're already kind of retesting into those spaces. Same thing. Look at this. I mean, now, the market is just continuing to sell off here. For example, look at Square. Square went down to 191. 10% is going to be about 210. So again, this is me thinking we're not going to hit that dead bottom again, but I wouldn't be shocked if we retest some of those figures. So it wouldn't shock me if we go back into that range of 220 to 210 over here at square. I don't think we're going to reach those low lows over here. We had a lot of buying pressure come in when we really hit these lows of the day here, and that's why we didn't even close at those lows, right? That was just intraday. But anyway, those are some of my thoughts on pricing. Because when that rotation rotates back, which it always does, and it's so hard to say that when it hasn't happened yet, because it's like, oh God, well, what if it doesn't? What if inflation comes in and all just goes to zero? Well, you know, those are the fears that we mentally drive into our mind, especially when we look at things like the bond chart that we're talking about here with this increasing slope that we continue to see. Yeah, I mean, it makes you nervous, right? You don't get blamed for feeling nervous about this. And so ultimately, my strategy is just very simple. Focus on what I know is going to do well long term. I know that in the short term, reflation stocks are going to do well. I want people to make money there. I'm grateful for that. I want to make money in the long term, mostly because I don't want to go into reflation, make money, sell, try to time my way into tech when the rotation comes back, pay taxes, potentially miss the opportunity to have loaded up on tech or some of these other stocks that I like the Etsy's and so on. And then try to buy in at higher prices plus pay taxes by missing the bottom. Not interested. So those are my thoughts. Now, I do want to say, here's our slope. Let's do this one more time here. Here's our slope of the 10-year this time. We are on the 10-year. And the 10-year right now is at 1.73. Let's go back to about 6 months here. So instead of a year. So the last 6 months, you could see we've had sort of a growth here from about September to where we are now of the red line. Let's do a slope here from top of market, like Feb 16 here. Yeah, we see the rate is accelerating here also. The green line is an accelerated slope. Certainly if we go over here to March 2nd, same problem. And if we continue to go in over here, yeah, look at that. Even if I just go from peak to peak over here, we still have a higher slope than we do at the green point here. So rates are still accelerating at a faster pace than, or growing at a faster rate than we even had at the end of February. So the short-term forecast, not so good. And I'm a little bit concerned about it. But I'm staying true to my strategy, and I'm diamond handing. Thank you so much for watching. If you found this helpful, consider sharing. Check out the programs linked down below, and we'll see you in the next one.